Welcome to Dealmaker Live. This is a show for real estate entrepreneurs who are looking to make deals and get paid. My name is Matt Skinner. I am your host and I am the Dealmaker. Today we're going to be talking about the 3 strategies that you can deploy when you're investing in apartment buildings. Actually, more broadly, you can use these 3 strategies, and everybody does use these strategies for all commercial real estate. But we're going to be talking about the appreciation play, we're going to be talking about cash flow play, and of course the value add play. And you know, what kind of people are looking for what different types of deals? Why would you want to get into an appreciation play? Why would you want to get into a cash flow play? Why would you want to get into a value add play? So we're going to be talking about those 3 strategies. Today is our flagship show of Dealmaker Live. I'm super excited about this. We'll be coming to you live every Wednesday at 3 o'clock. We're going to be publishing a phone number so that you can call in live and ask questions live. Try to stump the Dealmaker maybe, right? We're going to have a lot of fun with this thing. We also have a killer lineup of guests that'll come on from different aspects of the industry. People that will come in and share their knowledge about how you're going to be able to make more deals and get paid more by watching this show. So we're excited to be bringing this to you. So let's go ahead and dive in. There's literally 3 strategies in the commercial real estate field that maybe, you know, some people even who are investing one certain way may not even understand why people do it the other way. In fact, one of the biggest questions I get all the time, I live in Los Angeles and I've lived in Orange County, and there's rent control in Los Angeles. In fact, the governor just signed a new bill into law. I'm not exactly sure how that is going to be implemented or what that means yet, but I got a lot of ideas about it. We'll be definitely be talking about that in the future. But why would somebody buy a rent control building? You know, that's a big question. One of the first buildings I ever bought was a rent control building, and there's pros and cons to it, just like any other investment strategy. And that comes into place with the appreciation play. So here I got the 3 strategies here on my whiteboard. I'm going to demonstrate this to you real quick. For the appreciation play are typically for folks that have a lot of cash on hand, they've made a lot of money. They might not just be folks, they might be financial institutions, they might be people that are looking for a safe, secure, stable place to park their money, right? And so in that case, buying in a big city with super low cap rates is a great play. People that want to park their cash and not lose it, it's a safety play, right? It's a place where they know that they can get tax advantages, they can get some cash flow out of it, and they're probably not going to lose a lot of money by investing in a big city with low cap rates. Because after all, low cap rate means low risk, right? High cap rate means high risk. A lot of investors get that mixed up. People think that a high cap rate just means a high return, and that's not necessarily the case. You can make killer deals in big markets that have 3 caps and 4 caps. You can also make killer deals in markets that generally trade in the 9 and 10 cap rate. You just need to understand that the 10 cap marketplace is a higher risk market than a 3 cap marketplace. And so people that are looking for low risk investments, people are looking to put money into a deal where they know that it's going to grow over time and with very little risk of losing any money, are going to get into the appreciation play. They're going to get into markets where they know that values constantly go up. Places like Los Angeles, Orange County, San Diego is one of the highest rated apartment markets in the country consistently. San Francisco, Manhattan, you get the idea. Dallas is has a lot of great appreciation plays in it. Chicago. Big cities typically are more stable. Why? Because lots of people want to live there, and it's super expensive to buy a house. So an apartment is a more affordable option for folks that move to the cities, move to these larger cities. And so there's always a greater demand in these big cities than there is supply. One other thing I'll say about that, as a real estate developer, I'll tell you, in the bigger cities, especially in California, Chicago, and some of those, you know, more left-leaning cities in their politics, they make it really difficult to build new stuff. Did you know that that's fantastic for a real estate investor? I love building stuff in LA because it's difficult to get permits. It's difficult to find land. It's difficult to go through navigate all of the bureaucracy inside the city in order to get permits. But think about this in a different way. When the government interferes with new development, new product, and all of these things by making it difficult for developers, you know, one of those unintended consequences is they're restricting the supply of new affordable housing, new apartment units coming on the market. And what does that do for the marketplace? It raises the value. When the demand is bigger than the supply, the values go up. And that's why an appreciation play works really well in a larger city. We'll talk more about rent control and the effects that has on the market. We'll also talk more about cap rates and risk and all those kinds of factors on future shows. But suffice it to say today, appreciation plays is a great place to invest if you want safety, if you want stability, and if you want to know that you're going to have a reasonable amount of appreciation over time with very, very little risk. Now, let's talk about the cash flow play for a second. And cash flow is a big buzzword for a lot of investors. People want cash flow, passive income, massive passive income, all these kinds of things, right? Cash flow is the lifeblood of creating wealth. The new wealth today is when you have more passive income coming in than your monthly expenses are, you are financially free. And that's our goal for our investors, is to help our investors get financially free. And it's powerful. But one of the things I want to share with you about that is you're not going to get typically a lot of cash flow out of an appreciation deal. Appreciation deals are not known for specifically throwing off a lot of cash. If you invest San Diego, LA, Orange County, Manhattan, all these kinds of cities that we just mentioned when we're talking about the appreciation play, they're not big cash flow states. However, I can tell you I've bought buildings in Los Angeles with rent control with a 13% cash on cash return in the market. Do you know how we do that? Creative finance. Seller carry, seller finance. We use options, we use lease options, master lease options, we use all-inclusive trust deeds, we use seller financing, seller carryback, subject to, all these different techniques we're going to be talking about in our tradecraft sections on this show, Dealmaker Live. But I just want you to know that other markets, sometimes you go into other markets, they throw off a much higher cash flow. Typically those markets are higher risk markets with a higher cap rate. So if you go into a market with an 8, 9, 10, 12 cap rate, they better throw off more cash. They better be paying you higher because you're taking a higher risk, you're in a less quality marketplace, and they better be putting out more money because the rule to investing is just that, right? The more risk, the better the reward should be. And that's what cash flow is all about. Now, cash flow is awesome. You can create cash flow in any market, in any place, if you make the deal right. And one of the things I always tell my students, I always talk about with my acquisitions team, is great deals are made, they're not found. They're not just going to fall out of your lap and land in your lap all the time. You got to hunt for them, you got to work for them, and you got to know what you're doing. And if you're a great negotiator with lots of different buying options, like all cash, quick close would be one buying option, seller financing, another buying option, traditional qualifying for your own loan, making a traditional down payment, that'd be another option. We have different options, different tools in our toolbox to make great deals and get paid. And we're going to be teaching you how to do those kinds of deals right here on Dealmaker Live. Last strategy that I want to talk about is really one of my favorites, and that's the value add. Value add means it's a property that has a problem. And you're going to literally go into that property, buy that asset, and do something either physically or maybe management-wise or marketing-wise, do something to increase the value of the property. A lot of times, people think about just, fixing it up physically and making it more valuable. But in commercial real estate, just looking nice doesn't give it its value. Commercial real estate is evaluated on its income minus its expenses, gives you a net operating income, and then when you apply the market cap rate to your net operating income, that gives you your value. One time, a couple of years ago, I was fortunate enough to buy an asset in Tempe, Arizona. It was from a guy, great guy. He's a great investor, had a big portfolio, and I came across this property, and it was completely vacant and completely renovated. Perfect condition. It was beautiful, beautiful building. And it was right by Arizona State University. It used to be a fraternity house, and for all intents and purposes, I'll say that's not either a good thing or a bad thing. The guy did a master lease with the fraternity. It was a long-term lease, had locked in specific increases. So from a safety play, from an appreciation play, it was a great deal for him. But the factor that he didn't factor in was these guys were rowdy. Friday night fights, that's what the newspaper said. This fraternity house would invite guys from other fraternities over, and they would literally go out in the backyard and do bare knuckle brawl in the back parking lot of this apartment complex, this fraternity house. And unfortunately, one day, one kid got some Bacardi 151 thrown on. This is on the newspaper. This is before we bought it. Bacardi 151 thrown on him and lit on fire. And that caused a whole cascade of lawsuits and insurance problems and bad publicity for the asset. And so when I met this seller, he was literally at the property just finishing up getting that tenant, that fraternity evicted. And so it was a completely vacant building, and it was completely in perfect condition, and we were able to buy it for a deep, deep, deep discount. In fact, we bought it, leased it up, sold it about a year and a half later, and made a fantastic return on investment from that. And the point of my story here is that was a value add deal that had nothing to do with the physicality of the asset, had nothing to do with the paint job, the peeling paint, or anything like that. It was in perfect condition. The problem wasn't even with the former owner, right? He didn't do anything wrong. It was just circumstantial. And so we were able to step in, and by the time, he could have leased it up, he could have done all those things. It was just an emotional decision. He had an emotional problem with the property because he didn't want to go through, re-tenanting the building, deal with all the lawsuits and the insurance and the bad publicity. We went in, renamed it, put new tenants in, and did really well with it. And so when you're a deal maker, you have to be able to see the whole field of what's going on. You have to be able to see the big picture in order to make great deals and get paid. In just a minute, we're going to start talking about market cycles and which types of strategies to use in different times in the market. And we'll be back in just a minute. Welcome back to Dealmaker Live. I am Matt Skinner, your host and the Dealmaker. This is a real estate show for real estate entrepreneurs who are looking to make deals and get paid. Right now, I want to talk to you about different market cycles, right? I want to talk to you about, what kind of strategies we should deploy in different market cycles. And so I'm going to pull out my whiteboard here. I'm going to draw a little funny sketch for you. I'm going to do the best I can as an artist. And we're going to talk about what market cycles look like. The first thing we want to talk about is if you invest in the stock market, you've got you can see a stock ticker that kind of looks like this, right? It goes up and down, and that's in one day, sometimes even in an hour, you got these crazy numbers. But in the real estate market, we've got kind of a slower moving ship. And yes, we have ups and downs. We've got peaks and troughs and all these things. But the one thing that's happened in American real estate is ever since the inception of ownership, which actually was a revolutionary idea to let anybody own property in a country. It was like one of the first country that ever was enabled. That's why this country is so amazing and so awesome, such a land of opportunity, because we're the first country to let anybody come and get some land, right? If you were able to come here, you could get some land. And because this country is so great and grows constantly from immigrants and birth rates and all these things, the demand for real estate keeps increasing because our population keeps increasing. So as long as our population in this country continues to grow, we will continue to see an overall upward trajectory in overall values. So if you buy real estate and hold it long enough in America, as long as our population keeps growing, you will see a return on investment over time. Now we also have market cycles, and that's what this squiggly line begins to demonstrate here for you. And what we see here is peaks and valleys, right? So we might look at this and say, around 2000 we had a bottom out, we had a trough, we had the dot-com bubble burst, and things were low, and then we started to creep back up during what we call the roaring 2000s. Around 2008, we kind of started to hit our peak, and then we had a free fall, one of the largest free falls in all of history. Now, I don't predict that we're going to see that again unless we have another episode of rampant fraud and government too much government interference and too much government regulation forcing lenders to give loans to people who could never pay them back in the first place. We had stock traders out there trading loans back and forth because they wanted to dump all that crappy loans that they just were forced to give out. And so we had this huge systemic problem in our economy, and that's what happened. It collapsed basically not just America's economy, but affected many, many parts of the world when that happened. But so I'm just trying to say that I don't think we're going to see a huge, another huge depression-like recession, probably not in our lifetime, unless we continue to have bad politicians doing bad things and bad people on Wall Street that aren't allowed to just do whatever they want to do. But anyway, long story short, either way, we see the market ebb and flow. We see the market peak and valley. It goes up, it goes down, it goes up, and it goes down. But overall, it goes up over time. And so when we get back to our my little sketch here, and we'll just leave that. Go ahead and leave that up for now. I'm going to draw a little bit here. Lane's my main man. He produces the show, makes all this stuff happen. I'm definitely going to drag him on up here one of these days. But just a shout out to Lane for putting all this whole thing together. So we have these peaks and we have these valleys, right? And the question is always like, well, how do we know when we get to the top? And how do we know when we get to the bottom? The rule of any real investing is to buy low and sell high, right? So if you bought down here in 2000 and you rode the wave up and started selling in 2007, you could have made a pile of money. It doesn't matter what you bought. Bought houses, bought apartments, bought commercial, bought land, anything, because everything was just going up, 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 big, huge growth spurt in the economy. But how do you know when you're going to hit this peak? And what strategies should you deploy, right? So we already just talked about at the bottom of market, you can basically buy anything as long as you exit before you peak. But one of the things I want to point out is, what do we do in a peak market? I mean, it's a great time to be a seller here and a buyer here, right? And if we're at the top of the market, which a lot of people are beginning to think that we might be, right around here. What year is it? 2019? We might look. I think we're probably going to be looking at some kind of recession, some kind of a real estate recession coming up in the next year or so. I've been predicting that for the last 2 years. I think interest rates will have to rise. I think a lot of it will have to do with what political things happen in the next cycle, and many, many other factors with trade and all these other things that are going on in the world. We'll talk specifically about each one of those items right here on Dealmaker Live in future episodes. But today, we want to say, all right, so if we're at the top of the market, what should we be doing, right? And if we begin to get into a recessionary period where prices might begin to fall in commercial real estate, that would be cap rates beginning to, to move in the right direction, or in the wrong direction, I should say. These are the things that we want to begin to identify. But with the exception of the rampant fraud that we saw in the last recession, I want to tell you, real estate is a local market. It's a local economy. So if you're investing in a city, in a town, in an area that is growing in population, your value of your assets are going to grow. Just as simple as that. And so the number one thing we look for when we look at new target markets to buy in, we look at population growth. Are there new jobs coming? Are there new companies coming into place? Are there people creating new jobs and new opportunities in a marketplace to grow the economy? Some of the things that the way to predict that is every single city has an economic development plan. And that's the city's strategy to bring in more tax revenue, right? All businesses want to grow, government wants to grow too. And the way the government grows is to get some money from somebody. There's two ways the government goes about that. Number one, they can just raise taxes on all the businesses and people that already live in the city. That's one way to do it. And another way to do it is to bring in more people and more businesses so that everybody may not have to pay more, just there's more people paying it. And so cities, are vying for large companies like Google and Amazon and all these kinds of companies like that to come into their town so that they can generate more tax revenue without raising the taxes on the existing folks that live there. So just a quick microeconomic conversation, but it's super important when you're thinking about investing in a city or a town or even in a state. And so getting back to my little squiggly lines here, if we're going down in a recessionary market, this is the time where you want to be doing what we call transactions, right? You can buy and sell your way the whole time while the market's going down. It's also could be a good time for real estate agents. There's a lot of people that need to sell because values are dropping. There's a lot of people that getting in financial trouble, things like that start going on. When the economy starts crashing, there's more divorces, there's more health issues. These are just the way that it is, unfortunately. And so if the market's going down, you want to set yourself up for buying and selling. That could be buying, fixing and selling. That could be buying and turning around a quick sale. We like to trade options, buying options on property and selling those options. A lot of fun. We're going to teach you some more about that on Dealmaker Live. And so you want to look at a downward trending market as a transaction market. And when we get to the bottom of a market, when we start to see this turnaround in the trough, job growth, businesses expanding, public announcements about companies moving to town, this is the time where you want to begin to buy and hold. 2009, I remember seeing Rick Perry, who was the governor of Texas at the time. I literally saw a commercial in California, and Rick Perry's on the TV saying, hey, listen, California residents, if you've got a small business and you want it to grow, come to Texas. We're going to give you low regulation, low taxes. We're going to treat you well. This is a friendly environment for business. And you know what? Texas boomed, first state of the whole 50 states to come out of the recession. They probably even felt it one of the least in the country. And I think Rick Perry had a lot of guts to go out and do that in front. I understand he also ran those commercials in New York State as well. But the long and the short of it is, while other states were really suffering in recession, Texas began to boom. They started attracting business because they made it more affordable for them to do business in that state. When I saw that commercial on TV with Rick Perry, I ran to Texas and we started buying assets there, and we did really, really well. So at the bottom of the market, you want to buy and hold, and ride the momentum of the market up, right? Pretty simple stuff. So these are the kinds of strategies that you want to play. We have our transactional market, flipping, transacting, maybe even listing properties in a downward trending market or even at the peak of a marketplace. When we get to the bottom of a marketplace, we want to buy and hold. Value adds can be done in any market cycle at any time. So if your strategy is to do value adds, you can really do that at any point in time. So the other thing I want to say about value adds is they're also the most labor intensive. They're also the most mental intensive. Like, you got to know what you're doing if you're going to go in and turn around a 100-unit building. Even if your plan is to go in and turn around a 5-unit building, you got to know about, like, how do I get my tenants out? How do I market the property to get new tenants? How do I do construction? How do I manage a plumber? I don't know about you, but have you ever been home waiting for a plumber and the sucker doesn't show up on time? Like, it's a pain in the butt. Imagine if you have a whole project running like that. Plumbers, electricians, drywallers, concrete guys, landscaper, all these guys, right? Like, trying to manage all of that is a whole skill set in itself. So just to say, value add is not for the faint of heart, but oftentimes has the largest returns possible. And when I talk about value add, I'm going to include new construction in that as well. New construction is a great opportunity and is also considered a value add opportunity. We love doing new construction stuff. In fact, I'm working on a 77-unit building right now that we're probably going to break ground on in Los Angeles. Because of the rent control rules, I think it's going to be a great opportunity. It's in a great location. Brand new construction actually has some exemptions from some of the rent controls, so I think that's going to be a huge value add opportunity. All right, guys, but before we conclude today, I want to tell you a little about my Dealmaker Society. I've got a group coaching program that is awesome. That's all I'm going to say. It's awesome. So what that is I have over 100 hours of video archived in a website called dealmakersociety.com. You can go there and check it out. When you join Dealmaker Society, you become a member of a secret society of real estate entrepreneurs. And the way that I've designed this is so that it's not me it's not just me telling you this, telling you that. It's a group of people that are actually doing deals in the marketplace, sharing secrets, sharing tips, tricks, techniques, and not just about real estate deals. It's really about who you need to become in order to do and have everything that you want in life. Who you need to become is going to matter about your success, right? Because one of the things that we focus on inside of Dealmaker Society, and I wrote about this in my book, The Dealmaker Manifesto, it's not about knowing how to do real estate. It's about knowing who you need to be in order to be successful at anything. And to be successful at anything as an entrepreneur, you gotta know how to market yourself and market your business. You gotta know how to market your properties. You gotta know how to sell. You gotta know how to negotiate. You gotta know how to create business systems and processes. And you gotta know financial intelligence. And so we focus on those 5 pillars, and we train on it, and we coach on it, and we teach it inside Dealmaker Society, and it's awesome. We meet on Saturday mornings to go over anybody's deal who's a member. If you're a member, you can bring a deal to the table. Any challenge, any business strategy, any marketing ideas, whatever you want to come in and ask questions, I'm there to help and coach my guys to become better deal makers in their own business. So if you want to check that out, it's at dealmakersociety.com. We're going to be live next Wednesday, same bat time, same bat channel, 3 o'clock on Wednesdays. That's Pacific time because I'm in Los Angeles. 3 o'clock next Wednesday. Don't miss the show. I'm going to have a phone number attached to this. You're going to be able to call in live. If you can't call in during the time, don't worry about it. You can call in the rest of the week, leave a message. We'll pick the best messages with the best questions, and we'll play them on the show next week and in future shows. We'll answer your questions, and we're going to have a lot of fun doing this. We've got guest lineup that we're going to be doing. We're going to do some deal analysis on this program, and we're going to do a lot of tradecraft. Tradecraft is teaching you literally the craft of mastering this trade. So I'll see you next week. Dealmaker Live. Here, everyone asks me, how are you able to consistently beat the market investing in apartments? And I answer, it's all about my secret sauce. My secret sauce has 3 ingredients. For the last 10 years, I've been buying apartment buildings in emerging markets. An emerging market is a major city that is ripe for growth, with transportation hubs, communication, and big businesses creating jobs. I picked Texas in 2009, and soon after it was the fastest growing market in the country. In 2014, I went to Phoenix, and it's now the fastest growing city in America. Jobs bring people, and people need housing. So ingredient number 1 to my secret sauce is buying apartment housing out in front of big cities, getting ready to grow. To learn the other 2 ingredients to my secret sauce, check out matt.skinner.investments.com. That's matt.skinner.investments.com. And while you're there, watch a video tour of one of my latest apartment buildings being renovated. And don't forget to download a prospectus about investing alongside me in my next killer deal. Go to matt.skinner.investments.com. That's matt.skinner.investments.com.